Hello, everyone, and welcome to my video on my PnL tracker that I created. PnL meaning profit and loss. And the goal of this training is to make it so you can do your bookkeeping easier and more successfully, and have a better have the supporting documentation you need from the IRS's perspective. And so my name is Jason Fila. I'm a CPA and have been for 5-7 more years. And I've worked with hundreds of different business clients throughout these years. And really my main focus is on federal income taxation. And that's what I love. So I've got some other presentations I'm working on. This is my first one, but when they're out, I'll let you know, or you can reach out to me to see when they're coming out. But one of my other videos is called, Am I Losing Thousands on Taxes? 5 Strategies to Stop the Hemorrhaging. And the other video on top of that I'm looking at doing right now is S Corp versus sole proprietorship. What is the right entity for me after tax reform? So reach out to me to see when those are going to be ready. I'm happy to send those links to you later on. Now, just so you know, what I love to do is save people money on taxes. That's kind of like what I love about my job. To me, it's like it's the equivalent of a football player who's a star football player walking into a stadium and everyone's chanting his name and shouting, and you got 70,000 people cheering. And in my head, that's what goes off for me when I save someone like $5,000 in taxes. You know, for a small business owner, $5,000 is, it's a little chunk of change. So my goals when I'm working with clients are save you as much money as legally possible. Because if you're not saving money on taxes, then you're losing money on taxes. And there's no reason to overpay on taxes. Now, the other goal is keep you out of trouble with the IRS and other taxing jurisdictions, different states. And then I also want to keep in mind the bigger picture. And from my perspective, if you become a successful business owner, that's a huge accomplishment. But if you can't make that leap from successful business owner to successful investor, then I hope you really love your business, because you're going to be working in it for the rest of your life. So my goal is to make it so we're not just saving you money on taxes every year, but we're taking the bigger picture into account. And for most people, they want to be able to get to that point where they choose how much they want to be involved in their business, if they want to cut back, or if they say to themselves, I have enough money, I can retire. That's what I want for my clients. So I have that on the back of my head as well. I had a client not too long ago where she became a very successful business owner. She was making, a few $100,000 a year, after being in her business for 10, 15 years. And she was just paying so much in tax. And we set up this just wonderful, hefty retirement plan. And she put away $150,000 a year into her retirement plan, and saved her $40,000 to $60,000 a year in taxes. I mean, another way of looking at it is she was throwing away $40,000 to $60,000 every single year in tax. So when I say these things, I really do mean it. I'm looking at these things as some of my major goals. Another one of my goals is keep things as simple as possible, given all the other things I'm trying to balance. I'm trying to save you money. And then lastly, I'm trying to provide you tools to make your life easier. And so in light of that goal of making things easier, I've created this profit and loss tracker here, which I'll now be showing you. Just a second here, and I will share my screen with you. This is my next presentation I'll be doing, Am I Losing Thousands on Taxes? So I actually presented this to about 900 business owners here this last year, and it a lot of becoming proactive tax planners rather than being a reactive taxpayer. So that's kind of the theme of this, is switch your mindset and save money. Back to the PnL tracker. So this PnL tracker, its goal is to kind of keep things as simple as possible, and to make sure you try to help you not get audited, but to some degree you just can't fully control that. some audits just come randomly. I will say a huge chunk of audits come because someone messed up, you know. And so my goal is to make it so we don't mess up. So we're avoiding, we're going to be strategic. Even if you can claim some of these really, legit expenses, we may be more strategic in how we're going to do that or how much we're going to claim of it if it's in a high risk red flag area. So this is intended to save you some money because then you don't have to go out and buy QuickBooks and try to learn how to use QuickBooks and get all complicated with that. I'd say some businesses need to go to that level, but a lot of businesses can start out using this PnL tracker and maybe able to just use it for the entirety of their business. So this workbook I created, each tab is color coded. So this first purple tab is called the substantiation required. So this is just informational. So this is just talking about what do you need to prove to the IRS in order to get your tax deductions. And for most deductions, it's twofold. Okay? The first thing is you need to be able to make sure you can prove that you paid for a business expense. You also need to prove what you paid for, right? So in other words, the IRS wants proof that, hey, this is actually a business expense, and that's what the receipt and invoice provides. And then the other thing that they want is they want to know proof that you actually paid for it, because you can get an invoice and just not pay it, right? And so the IRS wants both elements. Well, what proves that you paid it? Your business bank account. So every business owner should have a business bank account and or a business credit card. And what should flow through there are business expenses and business income. Now, if you need to put money into your business to fund it initially, or let's say you get low on funds in the business, you need to put some more money in there from your personal account, you can do that. That's totally fine. It's called an owner's contribution. It's not taxable, but we still need to make sure we categorize that. And so I will show you later on in this workbook how we account for that, because at the end of the day, if the IRS comes in to audit you and you've done these owner's contributions, we don't want them coming in and saying, oh, this must be income, right? Because it's a deposit into your bank account. We want to prove that it's not. And so that's what the purpose of this workbook, one of the things this workbook does. Owner's distributions, things that you take out of your account for personal use, is another thing that we will track in this workbook. So basically every debit and credit, every transaction that goes to your business bank account or onto your business credit card are things that we're going to be tracking on this workbook. So the invoice or the receipt proves what you paid for. It proves that it's a business expense. And some of these things, you may need to get a little bit more granular on, like meals. You want it, you want the date, you want the place, you want to, what's the business purpose. You just write on the top. You got to talk about who attended. Some of these things get a little bit more idiosyncratic, but the other major thing we'll talk about in this workbook is the expenses for vehicles. So you can use either the actual method or the mileage method, either one of these two. Once you choose a method for a business vehicle, you stick with that method. You can't change from year to year. And with the actual method, you're going to deduct the cost of fuel, the cost of insurance, cost of repairs and maintenance, and then the cost of the vehicle, but we take that over 5 years and we call that depreciation. And if it's 75% used for the business and 25% used for personal, we'll only deduct 75% of this stuff. If it's 100% business, we'll take 100% of the business cost of these things. Mileage method is basically as simple as it sounds. You just need to keep a mileage log, essentially, and all the business mileage is what you will be deducting. So you still have other things you need to keep track of with these things, though, and this kind of goes over what you need to keep track of. So use this as your reference point. But you can use a log book, or you can just keep. A lot of people use MileIQ. I would say don't use a free app on this, because a lot of people, I've seen, some people who have accumulated substantial business miles and it's free, and then all of a sudden the app is not making any money, and so they just shut down, and so the person's mileage is lost, right? So I would say skip this free stuff, pay the $5 or $7 a month if you're going to do the, the smartphone app stuff, and then you can just swipe business or personal. You know, and if you do mileage, you still, if the IRS comes in to audit you, they're not just going to ask for your logbook, because the IRS basically has seen or believes there's been a lot of abuse in taking vehicle expenses. And so they're more persnickety, and they put in a whole bunch of rules around this. And so, you know, you're going to want to keep track of your, you know, if you get an oil change, you get repairs, keep those things, keep those records around, because the IRS is basically going to try to copy, you know, track your mileage logbook with these repairs. If it says your mileage here, you know, your odometer is at 115,000 here on, you know, January 15th, and this one says the same thing, then that supports each other. But a lot of people, surprise, surprise, haven't kept track of their mileage log very well. And so this is the way the IRS tries to essentially, you know, disannul their entire mileage deduction. So you give them a mileage logbook, and if you don't have these other things to back it up, they'll say, well, too bad, we're going to get rid of the deduction. So you want to keep track of these other things. If you got appointments, an appointment book or calendar of activities, you know, that would be other substantiating evidence of your mileage deduction. Okay, so I'll let you kind of go through this, and if you have any questions, you're welcome to reach out to me on these things. But so this next tab, the red one, just explains how to use the workbook, which is what I'm explaining right now. But this is just kind of that in general, high-level sense written out. And okay, so these two tabs here, the two blue tabs, are the output tabs. And really, you know, what you want is a profit and loss statement, right? This is what you need for tax purposes. It's also useful for management purposes, right? Analyzing your business and taking a look at when you have the revenues. There's their seasonality. Did a certain promotion work? And it's helpful to look at this over time. And so you can track this by month. Is the most granular. So basically, we have three ways of viewing this. The most high level is, here's everything. Here's all the income you've tracked for the year, all the expenses, and here's your net income. So expenses, your income minus expenses is your net income. This is before your home office deduction. And here, then we've got the next level of, you know, detail. So this is the most high level, least amount of detail. Here's the next level of detail. So what we do here is we've got these accounts. Okay, here's all these income accounts here. So it starts with account 100. That's just the account number, and then we have the account description. So sales, including sales taxes. So, you know, a lot of states are not going to tax services. Some states will tax services. Some will do it in certain circumstances. Some in other circumstances. So, you know, we've kind of just given some high-level ways of viewing your income. If you don't need to track all of this, you know, if you've just got a business, it's a service business that excludes, that you don't really need to have sales taxes on, you just put it right into account 103. Or you can I'll show you how to create new accounts. If sales taxes is an issue, then this tutorial is not going to be enough of an explanation as to how to track that. We'd have to have a follow-up conversation, because it depends on the state, depends on, you know, more information from your business is needed for me to give you good advice on that. But essentially, you could track that here. You could put by locality, you know, here's retail sales in this locality, and this and this and this, and you could track your sales that way to be able to give you that, you know, the amount of sales tax that you should be collecting and remitting, and to make sure you're not paying income taxes on your sales tax. Okay, contributions, like I said, this is not actually taxable income. That's why I back it out right here. And this is what would hit your final tax return. So this is all the information you input, you know, on other tabs is going to flow right to here. And then this right here is where I make some, you know, various adjustments. And then this is what's going to hit your final income tax return. So contributions is not taxable. I back that out, but we still want to track it, because if the IRS is looking at your business account, they're going to want you to show that you've accounted for every single transaction. So that's why we're making sure we're tracking it. Okay, expenses, again, distributions. This is income this is money you've taken out of your business for personal use. And again, we don't want to do any of that commingling, is what they call it. So if you've got your business account, you don't want to go do grocery shopping on your business account, because the IRS calls that commingling, and they don't like it. It makes them much more persnickety when they're auditing you, and they will start saying, prove to me this was a business expense. Give me more, you have to take it to a higher level of trying to give them proof that certain things are business expenses and certain things aren't. So I would say, if you need money from your business account, take it out in lump sums, and that's how you can, be living off of the income from your business account. And if you need to, and that way you keep things separate. Okay. So you've got, a multitude of other business deductions here. And, okay, so you see all these blanks here. You've got the account number, but there's nothing there. I can show you later, and I'll show you later how to add a business account description here. So you can, if you're looking at these different descriptions and you're not finding one that kind of matches what you think it should be, you can just add a new description here. So, okay, so here's this next level of detail where now you're able to track this by month. Now, I don't personally need this track by month. I don't need a month by month breakdown. This is for management purposes. So this is to help you get some insights into your business. If you don't want to use this function, that's totally fine. The whole goal of this workbook is to basically help you and Okay, so those are the two output tabs here. So we've got 3 input tabs. This is where you're going to spend 95% of your time. So really, to use this workbook, it's actually quite simple once you get it all set up. Okay, so let's say we have a service business and we don't have any sales tax. All to account number 103. And okay, the month, January. So really, you just have to fill out these first 3 columns, okay? And if you do that, the amount, the account numbers, which is a drop-down list, you can't type in here, where you can choose, and then the month. So these 3 columns is what I need and what you need. So if you do that, then all of a sudden, boom, we see, okay, highest level PnL, okay, we got total income 4,000. And then if we go a little more granular, we see, okay, this is from services, and there's no sales taxes in so 4,000. If we want to be more granular, okay, now we got it by month. 500 in January, 1,500 in February, 2,000 in March. Okay. Now, if you want to, you can use these other columns here, okay? So what I do, and what I suggest for a lot of people, is you go into your business bank account. You're going to download to Excel your your account activity for the period, and then that's going to populate. And then you can copy and paste all of the deposits right here, all that deposit information. And sometimes they'll have a description of the transactions. You can copy and paste that in there as well, and you can put the date you received. Or you could, type in your own description of what this is here. If you've got some other information you want to throw in there about it. But you don't really, for this workbook to function properly, you don't need to use these other columns. But some people want that level of detail. Generally speaking, the more detailed you are, the more useful it's going to be in an audit. So, but a lot of people, this just gives you what you need right here. Now, if you wanted to, you can print your bank statement, and you can tie. Let's say you're going to have 20. Let's say you've got a whole bunch of small deposits. Okay, say you've got 20 deposits, and they're all $25 or $30 or whatever, $40, $50. You're going to have a whole bunch of these transactions. This receipt number here, this is so you can track and see, oh, this $25 relates to this one on my bank statement. And on the bank statement, you have, okay, here's a transaction for $25. I'm going to put an R4 there and throw it into my PnL tracker right here. So this way you're keeping track of each transaction. You know exactly which transaction relates to which line item here on the profit and loss tracker. Okay, so that explains the income and contributions input tab. Okay, so next is our expense and distributions input. Okay, so let's say we've got few transactions here, and we're just going to throw, okay, we've got, let's say we took out distributions of 5,000. Okay, that's not an expense, but we're going to track it still. Accounting, we got some meals. Let's say we've got advertising, and let's say we've got Okay, let's just do some months here. Okay, February and March. Okay. Now, again, this is all you have to fill out, these first three columns, and that's it. Amount, the account name, and the month. And so do that. Then we look at our highest level. We go back to our summary P&L tab. And boom, total income 4,000. Total expense is 1,250. My net income is 2,750. And so here we get a little bit more granular. We got 4,000, and this is the type of income it is. And we've got our expenses here: distributions, advertising, meals, legal and accounting, and computer. We're breaking this out. Why do we want to break all this out? Okay, I will tell you right now, for income tax purposes, for federal income tax purposes, I don't need all this income broken out, as much. Now, if if you have these sales taxes to contend with, you're going to have to break this out. But for federal income tax purposes, I don't care so much about how you break it out. But you may want to break out your income just for personal management, business management perspective and purposes. So you can do that. And this goes actually down quite a ways. I hit a lot of these rows because most people are just going to have a few different income rows to contend with there. In terms of these expenses, we want these broken out because we don't want to just give the IRS one huge expense category, because it draws red flags, and it's got to be broken out. And that's what they tell us. And so it's a way to make it so you're not going to get, you reduce your chances of being audited. Oftentimes, businesses have a significantly increased chance of being audited just because, they're not breaking things out enough, and they're not aware of these kind of red flag categories. So again, now we can break it out by month, and we can say, hey, January, total I've got 2,750 of income. January I lost 300. February I made 1,050. March I made 2,000. Okay, so we've got this. So that kind of goes into all of this here. Okay, so back to the expense and distributions input tab. These other columns here, similar to this on this receipt number thing that you can track, tie this to your bank statement, the income. You can do the same thing with the voucher number for expenses. And this, you'd put this voucher number on your receipt or your. So it's like, okay, here's this invoice, and this is going to be V1, and I know it relates to this line item into my P&L tracker. And it's a way to make sure you've accounted for everything, and it's a way to just make sure it's like super easy for, if you ever did get audited, that it would be a breeze to pass the audit because you've got everything so well organized. It's it's not going to take the IRS any time to get through it and just see exactly what you've done. It keeps everything neat and clean. You don't have to do it, but for those who have that proclivity and are pretty detail-oriented people, you can do that. Okay, so description. Again, I often just take all of my information here and all my debits in my bank account, all of those expenses. I'm just going to copy and paste all that information from the account detail. I download the account detail for my for the full year or whatever, or the month, however often I do this. Copy and paste just the expense category, just the expense information here, and then all I have to do is boom, add the account name and add this month information. Okay, so they often have an account description or a transaction description on that account detail that you can export it to Excel, and I will throw that into here. Or if you want to add your own personal note in here, you can do that too. So this is basically just to add some extra notes. Okay, this is to explain how you paid for it. So like I said, usually, basically always you want to kind of keep your business and personal things separate, and otherwise we call it commingling. But maybe you've got a business bank account, maybe you've got two business bank accounts, maybe you've got a profit and loss, maybe you've got a credit card, business credit card. Let's say you accidentally paid for a business expense with the personal card. So this is where you're going to say, this is how I paid for it, right? This is where you're going to go to find this expense on, you know, whatever statement. So maybe it's going to be my personal statement if I had a couple of those flow through there on accident or just out of necessity. And so, or most of them will be probably just through the business bank account or maybe a business credit card. And that you just put that information right in here. This is obviously, you know, receipt number, the invoice number, who's the vendor, who are you actually paying, and here's the date that it was paid, all right, or the invoice and receipt date. Again, you know, do you need all of this information? It's not absolutely necessary, but it would increase, you know, significantly the chances of your audit just going super smoothly, essentially. Okay. So with that said, okay, now this last tab here is what I ask my clients to send to me at the end of the year to make sure that I have the information I need. I don't have to ask you things in 10 different emails. So it's called the other information needed. So again, all these green tabs are basically where you're going to spend most of your time on this workbook, filling things out. Okay, so you're going to do home internet. And home internet, you're going to enter that as an expense in here. Okay, and then this is where you're going to tell me how much is for business use. So for most businesses, it's a fairly low percentage. It's somewhere between 5 and 30%. Now, if you have a career as a professional YouTuber, you know, and that's what you do, then maybe it's 90%. Or if everything you do, if all you do is use the internet for business and nothing personal, then, you know, but it's just so rare. It's mostly between 5 and 30%, I would say, is on average, and that's pretty reasonable. And I'll just say right now, caveat, my goal is to show the IRS we're being reasonable. If we're reasonable, usually that prohibits any audits in the first place. And if you ever are audited, then it shows the IRS, hey, I'm not being super aggressive. And so it's just an easy pass on the audit. So, okay, so here's the same thing for the cell phone. Cell phone's usually higher, though. It's usually you're using your cell phone more often for business. So often that's anywhere from 30 to, you know, 75, could be up to 90% or, you know, or more. If you have a cell phone that's just for business, obviously it'd be 100%. These two things are not part of the home office expense. So you have to give me those percentages different, you know, separately. This one here, enter the home office square footage. So a home office space is a space that's used exclusively and regularly for business, okay? So input the, you know, you're gonna do the measurements and show me what that is here. I also need the home's total square footage. And, you know, I will say, as with several of these different expense categories, there are two different methods you can use to track this. One for the home office deduction. One is the actual method, and so for the actual method, I need this for both methods. I need this information. Okay, the actual or the safe harbor method. But actual methods are going to track. You know, we're going to track utilities. We're going to track mortgage interest, property taxes, or the rent if you're renting instead of owning the home. You know, any repairs made to the office space. We're trying to track down that information. Now, you know, a lot of people don't want to go to that extra mile to try to increase that home office deduction. They just don't feel like it's worth it. I will say, you know, I am comfortable with using reasonable estimates in terms of tracking utilities and whatever. So I just don't want to become so onerous that it doesn't make sense for you to take the actual. But as long as they're reasonable estimates, you know, I'm fine with using that. You know, for utilities and home repairs on the home office. You know, mortgage interest, property taxes, we'll get those exact numbers. But safe harbor, which is, you know, simpler, is you give me this information and I take this home office square footage, I multiply by $5 per square foot up to 300 square feet. And so your max deduction for the home office under that method would be $1,500. So, you know, usually what I do is I get both information and I just choose the higher of the two, or people just give me this information and say they don't want to go through the process of giving me utilities and other things. So whatever works for you is just fine with me. Okay, so vehicle information. Okay, so here's where you're going to enter this information for me. So let's just say you've got a 2015 Honda Accord. Okay. And so when you do this, it will actually change the expense categories, and I'll show you that in a minute here. But this flows throughout the workbook. And here, so what, you know, if you're using the actual method, I need you to fill out this column here. And what value are we going to use to depreciate over 5 years? Well, it's the lower whatever you initially purchased the vehicle for, or whatever the value of the vehicle was when you started using it in the business. And again, just be reasonable. I mean, I don't, you can go to Kelley Blue Book and try to get an estimate there, or just, give me a reasonable estimate as to what the vehicle was worth, when you started using it in the business. And we put that in there, and then we do the date purchased. Here's where you're going to tell me, you want to use the actual or the mileage method? And if you're not sure, then that's okay. Just leave it blank and I will figure it out for you. The first year, we can choose between the two methods, and we can just take the higher of the two. After that, we just stick with whatever method you first started using. You can have, any number of business vehicles used in the business, and you can use different methods for each one. You could use mileage for some and actual for others. So if you're using the mileage method and you've tracked your mileage on like Mile IQ, then this is where you just give me the mileage number for the year, the business mileage. If you are, some people have a vehicle that's just for, only via business use. And, if they're not using the Mile IQ tracking tool, then maybe what they do is they just give me the beginning odometer, ending odometer, and that's fine because it's all business anyhow, and they're not doing any personal on it. The other thing here is if you're using the actual method, I need to know what percent the business, what is the business use percentage? And, you can just use a drop down here, because at the end of the day, we're not going to deduct 100% of your vehicle fuel costs for the year if you're only using 25% for business. We'll deduct 25% of those costs, right? Okay. Now, some people, I will say, they only purchase the fuel when it's for their business, and so and they only put it on the business credit card when it's for business. So maybe they say 25% of their fuel for the year is for business. So 1 out of every 4 stops at the gas pump, they just put it on the business, credit card or debit card. So in that case, you just put it at 100%. That lets me know that, hey, all that fuel should be deducted at 100%. Okay, so these are some other questions. This is just for my information, because one of my goals, I like to be a very proactive tax planner, and so as part of that, one of the things I do in November, December time period for a lot of my business owners, when it makes sense for them. If I do, I've got to charge for it, but essentially I do a tax projection for them, and this is a good opportunity for them to basically figure out before the end of the year. So I just did this for 2018, and it's now January 2019, but I did this in 2018, November and December, and for my business clients. And essentially, before the end of the year, they had a pretty good idea of what their taxable income was going to be and how much tax they were going to owe. They knew if they'd paid enough into the taxes or if they didn't. And so it provides a really great opportunity, because the year's not over, where they can implement changes that change how much tax they owe for the year. It's usually a much more relaxed time period. I mean, it's busy for us here in the CPA office, but we have more time to go with planning opportunities. We have more time to have these discussions, and so it's a pretty powerful meeting. It doesn't make sense for all business owners. It just doesn't. If you're just brand new in the business, it just doesn't make sense, because I got to charge for it if I do it. But if you're a little ways into the business, or you want to just start really kind of getting your handle on what to look forward to in the next few years in terms of planning opportunities, it may make sense for you. Maybe the first year it makes sense to do, so you make sure you paid enough income taxes, okay, as well. Okay, so you just tell me, are you interested in doing one of those? Okay, so if you're not an S corporation, do you want to chat about doing an S corporation? I mean, there's a good chance you've heard of them. And I would say historically, most people have opted to do an S corporation once they've gotten to be a successful business owner. Probably 90–95% have opted to do that. What I will also say with that is it's a full discussion. So I'm going to do one of these, probably do one of these videos just on that. But this is really something that's very, the conclusion is going to be, I've got to run the numbers, because tax reform really complicated choosing the correct type of entity for yourself. So I have created an entire workbook just to run the numbers and calculate if an S corp makes sense for my business owners. And so all my old business owners who were S corps, I had to go back and run these numbers and make sure it still makes sense for them to be an S corp, in light of this tax reform. So again, if you haven't explored this, it probably merits some conversation. And again, even if it's a year or two early, at least you have it on the back of your mind of what you should be expecting, when it may make sense, or it may never make sense to do this. So, but at least you should know you're doing the right type of entity. That's kind of the tax planning 101. Tax projection in November, December. Do you want to do this? Some kind of retirement plan in your business. This is. Part of the tax reform is that, you're probably not going to get a deduction for your charitable contributions from 2018 to 2025. So, but you can plan around it. You can plan around it. Basically I'm asking these questions because there's some planning opportunities around it, is what I'm trying to get at. So, just let me, you answer these questions, and then boom, I'm going to know right away if I can do some tax planning and save you some tax money. Now, this isn't obviously every question I need to ask, but it just gives me kind of some insight into what's going on for you personally and help me do better planning for you. Okay, so I mentioned here, okay, you can add you've got all these different, you can do up to, you can do 100 different income categories. How do you add new categories, right? Well, it's these last two tabs here, orange tabs. Here's the account number, here's the account name, and in this description column, these are my notes to basically help you understand what, when I put information here, this is what I'm talking about. Okay, so contributions, money from personal account to business account, not subject to income tax because it's already been taxed, right? So if you got to fund your business to start up, or your business account's running low, you got to put money in there, these are contributions. And you can just type in here, leave the account number alone, and then just type in, okay, new income account, whatever you want to call it. And then all of a sudden you go back to your income input and boom, account 106, new income account. So that's how you add. So go to one that's blank. You got plenty to choose from. And if you, and we can go from there. Okay, so for the expense category, there's, usually a lot more breaking out of, the expenses than income. But sometimes it can be the opposite or nearly the same with the income, depending on the business. Okay, so the first account 500, is distributions, money move. So this is what I'm talking about here. So I'm just going to go through here and just kind of talk about some of these things here. So distributions, money move from your business account to your personal account. It's not a tax deduction. Right. And I would say, again, don't make personal purchases from your business account. Make them from your personal account. Have those two separate. Don't commingle. And if you ever get audited, the audit will go better. Basically every single type of outsourced organization that you're going to be dealing with, creditors, bankers, whomever, want you to keep this stuff separate to the extent possible. So instead of paying for $100 worth of groceries, just transfer $500, $100, $200 or $500 or $1,000, a lump sum from your business account to your personal account, and pay for the groceries from your personal account. Okay, so advertising, accounting, business gifts. So some of these things are just used kind of idiosyncratically for certain business types. General contractors. So meals is applicable to a lot of people. It's only 50% deductible for tax purposes, but you've got to enter the full amount, and then I will take out the 50% that you're not going to be able to deduct. Okay, entertainment used to be deductible, but it's not until 2026. Again, meals is another high risk category. Usually it's like, okay, I'm taking out a current client, former client, or a prospective client, or I'm meeting with my, I'm going out to eat with some of my, some people who own similar types of businesses, and we're chatting about business. If you're going out to eat with a spouse or a significant other, and you happen to mention business, that's really not gonna apply. So, keep those things in account when you're doing this. Okay, so monthly cell phone bill, I will say here, let's say you've got $100 cell phone bill. Well, a lot of these companies don't even let you pay for the cell phone up front. They make you pay in installments. So of this $100, maybe only, $80 is for your, monthly data usage, and $20 is for the equipment. Well, we're only going to deduct the portion that's for your personal, or for your cell phone usage, not the equipment. We'll get the equipment comes in down here. When you purchase that equipment, even though you haven't paid for it fully, that's when we're going to take that expense. So this monthly cell phone bill, and then again, we're gonna only write off the portion that's related to the business. So if you've got like 4 people on the family plan and it's $500 a month, you're gonna take 25% of that, and you're gonna only write off that portion. And then again, it's on this other information needed tab where you're gonna tell me, oh, here's the business percentage of, business use percentage of my cell phone. And how do you know what that percentage is? I will tell you, there is no neat and clean, perfect way. Just be reasonable. You're the one that knows your type of business. If you made $100 in a year and you're trying to claim 90% business, that's not going to fly. If you made $100,000 a year and you claim 90% business, yeah, I think that's totally appropriate. So okay, computers. Desk fees. This is often used for realtors, donations. Okay, health insurance. So if you are covered by a spouse, if you are not covered by a spouse's health insurance, if you're not covered under an employee or under an employer health insurance plan, then you know what, you can often expense that health insurance cost. Now it is a business expense, and yet it's not at the same time. So it gives you an income tax deduction, but not self-employment tax deduction. But either way, this is where you would, track that. So just make sure you're keeping track of that. Here's the internet expense, like I said. Input the full amount here of what your monthly expense is. Make sure you get the full year's amount in there, and then tell me what the business use percentage is here. Okay, office equipment, you could put that, throw that in there. Okay, so here's where we get retirement plan contributions. You're going to let me know if you want to do a retirement plan, sometime retirement plan, and we can chat about this. There are so many different types of retirement plans, and they're for business owners. And I will say that this is a really wonderful way to do some tax planning. It really is. It's a great way to save some tax dollars and to get yourself set up for retirement at the same time. Okay, so taxes, we can expense most taxes, most types of taxes. If you have sales, if you've got, sales taxes, technically, you shouldn't, we just need to make sure you're only expensing it once. So if you excluded the sales taxes from these income amounts, then you shouldn't be taking expense for sales tax later on. But if you've got other state taxes, B&O tax, things like that, we can expense those here. Income taxes, IRS, we are in a pay-as-you-go type system in the United States. And so that means that you don't really know what your taxable income is until the end of the year, right? Until tax return time. That's when you figure it out. Nevertheless, the IRS wants you to pay income taxes, even though you don't really know what your income taxes, taxable income is going to be. So for people who are employees, you get your W-2, and they've been taking out income taxes every paycheck, right? And then your employer pays that for you. They're also taking out the payroll taxes for you, your portion, right? The employee portion. So, however, when you're a business owner, you're not getting that benefit. No one's taking that out and paying it for you. So the IRS still wants you to pay throughout the year. They want you to be paying throughout the year. So instead of every week, or every other week paying in the payroll taxes, the IRS allows you to do quarterly estimated tax payments is what they let you do. So, reach out to me. I can send you these quarterly estimated tax vouchers, So you're not getting behind on those taxes. It helps with cash flow purposes as well to make sure you're doing it. If you don't pay the quarterly estimated income tax, vouchers, then essentially what it comes down to is you're probably going to pay a little bit of a penalty. They're not obscene amounts, but on 300,000 of taxable income, you're going to pay $1,000 in penalties for not having made estimated tax payments. So essentially it's 0.3 or 4% or something like that, right? So yeah. So it's not obscene amounts, but a lot of people just don't want to pay a penalty. So if you don't want to pay a penalty, we do estimated income tax payments. This also covers your payroll tax, your self-employment taxes, the Social Security and the Medicare taxes. Usually your employer is paying that for you. If you're an employee, but as a self-employed person, you're paying the employer and the employee side of that. Plus you're paying your income taxes. And if you haven't been paying quarterly throughout the year, all of a sudden you're going to get slammed at the end of the year. Both sides of payroll tax, both sides of the self-employment taxes, Social Security and Medicare taxes, the employee and employer side, and you're getting nailed with your income taxes. So a lot of people who are self-employed get very frustrated and feel a lot of angst and say, oh my gosh, I'm getting slammed with these taxes. I would say reach out to me and we can get you some of these tax voucher payments made. Okay, travel, I'm just letting you know this is a higher risk audit area. I'm not saying you can't take the expense here. Totally you can. A lot of people do. I'm just saying that before you do, we need to have a chat. If you're traveling domestically, there's one set of rules. If you're traveling internationally, there's a whole different set of rules for how you're going to expense things. But let's chat about this, a category before you go into it. Essentially, domestic travel, it's an all or nothing test. To international travel, it's pro rata. So in terms of like airline tickets there and back, if the primary business purpose or primary purpose of the travel was business, meaning more than half of the days were business days, then you can deduct the full cost of the travel if it's domestic. Otherwise, you've got to do a pro rata if it's international. Okay, so wages, this is only if you have employees, because self-employed people do not pay themselves wages. That's a no-no. And it does matter, actually. It can affect your income tax situation, even though you think it doesn't. It actually can. Okay, so home office deduction, again, this is where you would, if you're going to do the actual method, this is where you're going to put that information. So the rent, only give me this information. This is where I put my description. Only give me this information if you want to use the actual method. If you're going to use the safe harbor method, all I need is go back to that other information needed tab, and boom, home office square footage, that'll do it for me. So you can use this blank if you don't want to use the actual method. You can, this is where you put the utilities, this is where you put the repairs. Okay, now let's say you're renting an office space that's not in your home office. You'd use account 554, office rent, not for home use, okay? Okay, let's see, if you buy a computer, we can expense, all or a portion of it, just depends on the business use percentage. 100%, we deduct 100% of the cost of computer. Okay, furniture. Again, these payroll taxes, this is only for people who have other employees. Okay, so let's see. Again, when I filled this out here, 2015 Honda Accord, it populates here, so I can track. Oh, here's my insurance expense for the Honda Accord. Here's my fuel expense for the Honda Accord. Here's the repairs for the Honda Accord. And again, I only need this if you're using the actual method. If you're using the mileage method, I don't need you to give me this information. I don't need this insurance or the fuel or the repairs. If you're using the actual method, if you have a loan on the vehicle, you get the interest on that loan. And that's the same if you're using the mileage method. We always get to take the interest on the loan for the vehicle times the business use percentage. If you're paying parking, if you're paying tolls, all of that is deductible regardless of using actual or mileage method. People I've seen often try to deduct the monthly payments on their vehicle, and you cannot do that unless you're renting your vehicle. If you're leasing your vehicle, then yeah, you can deduct the business use percentage of your monthly vehicle. If you own the vehicle, you will only deduct the interest portion of those payments, not the principal portion. Okay, so yeah, here's if you've got a home office, and then here's all these other places where you can add in expenses. So I hope that that gives you kind of a good overview of how to use this workbook. It's not necessary for all my clients to use this. I don't require this of them. I have a lot of clients that use, QuickBooks. This is for people who, the goal is to save you some money, so you don't have to go buy QuickBooks. So you don't have to deal with the complexity of dealing with QuickBooks. So for a lot of people, a lot of their businesses, this P&L tracker works just fine for them. If you have a business that's going to have some of these sales taxes and other things, then we should chat. We should have a separate conversation. People in the state of Washington, you've got a B&O tax that we may have to contend with that merits additional conversation as well. We haven't really chatted about state taxes at all in this, and this is for management, and this is I try to give you kind of a federal income tax perspective on these things. So hope you like this video, and feel free to reach out to me to chat. Let me just give you my contact information here. Jason Fila. It's Jason at waterfrontcpa.com. My number is 360-286-2080. So again, feel free to reach out, please, and ask any additional questions. The way I make my money is I do income taxes. I charge a flat fee, and I would love to just give you all one quote, but it's not fair for everybody because some people's returns are much more complex. If you've got 5 rental properties and 3 businesses, I'm not going to charge the same amount as to someone who's got 1 business, and it's a simpler business, right? So if I get an idea of what is going on with you, then I can give you a nice quote for how much I charge to do that tax return. We do tax projections, and like I say, my biggest thing I'm passionate about is doing proactive tax planning. Look out. Also, shoot me an email if you're interested in seeing these other videos. If I come out with them, once I come out with them, I will shoot you those links as well. And then if we need to have follow-up conversations, we can do that. So, all right. Well, I hope you all have a wonderful day, and thanks so much for listening.